Right. Diving right in today.
Yeah.
We're talking about something that, a lot of our listeners are probably already familiar with, but it's always good to revisit
For sure.
dividend stocks.
It's an important one.
It is.
Yeah.
Especially growing dividends, right?
Absolutely.
So we're going to...
That's the magic, right?
yeah.
I mean, getting a dividend is great, but if it's growing every year,
Exactly.
that's when things get really...
Compounding.
Compounding, yeah. That's when you can really see the magic over time.
And to kick off this exploration,
Yeah.
we're going to be looking at a Motley Fool article
Perfect.
from just yesterday,
Fresh off the presses.
March 31st, 2025.
Yeah. Always good to have a timely.
And they actually highlighted two,
Yeah.
quote, no-brainer buys
No-brainer buys.
for April.
For April. Okay.
Yeah, and those
We're
are...
going to dive deep on those.
Yeah, and that's what we're going to be focusing on today. Those are Brookfield Renewable
Okay.
and Enbridge.
All right. Two good ones.
Now,
Two big dividend payers.
the article actually starts out
Yeah.
with some pretty compelling data
Okay.
from Ned Davis Research and Hartford funds.
All right.
Looking back at,
for pumps, yeah.
historical stock market returns based on how a company approaches their dividend.
Okay. Yeah, that's good context.
Right.
Because, sometimes it's hard for people to visualize the difference between
Why does this matter?
different dividend policies.
Exactly.
Yeah.
Why are we focusing on growing dividends?
For sure.
And they found
what they kind.
that companies that consistently increased or initiated a dividend
Okay.
delivered average returns of 10.2%.
10.2%, that's pretty solid.
Yeah.
All right.
Now, that compares to
Yeah.
6.8%
Okay.
for companies that just stayed the same.
Right. So not bad, but
Or great.
not as good.
You're not really, beating the market there necessarily.
You're right. You're kind of just treading water.
Right, exactly.
Yeah.
And then
So that's fine.
the really interesting one here is
Yeah.
is the companies that cut or eliminated their dividend
Okay.
actually had an average return of
Yeah.
negative 0.9%.
Woof. That's a negative return.
Yeah,
That's not what we want.
not good.
So yeah, it really shows you that it's not just about the income.
Right.
It's a sign of a healthy
Exactly.
and growing business.
Yeah, and that's one of the things we really want to key in on.
Yeah, absolutely. If
Yeah.
a company is consistently
Yeah.
raising that dividend,
Yeah,
they probably have a pretty good reason.
something good down the line.
Yeah, got something going, right?
Exactly.
Yeah.
So let's look at Brookfield Renewable first.
All right.
Now they trade on the NYSE
Okay.
under the ticker BEPC.
BEPC, got it. And
Familiar with them?
yeah, as of yesterday, March 31st.
They had a market cap
Yeah.
of about $10 billion.
Okay. That's a pretty decent sized company.
Yeah, putting
Yeah.
them in that, major player category
Yeah, sure.
for renewable energy.
Yeah, they're one of the big guys for sure.
So think like wind farms,
Right.
solar projects,
Yeah.
hydroelectric power,
Uh-huh.
all that kind of stuff.
Yeah, the whole gamut.
Now, what's really interesting here
Okay.
is their track record.
What have they done?
Since going public in 2011,
Okay.
they've increased their dividend by at least 5% every single year
Every year. That's impressive.
for the past 14 years.
That is really impressive.
Pretty good.
Especially in the renewable space. I mean,
Yeah.
which has gone through
Yeah.
some ups and downs.
Right.
Yeah, that says something
It does.
about their management and their commitment to returning capital to shareholders.
It really does.
Yeah,
It shows a lot of confidence
absolutely.
in their business.
Yeah, for sure.
And, that consistency speaks volumes.
It does. It does.
It really does.
Yeah.
And during that 14-year stretch,
Okay.
the article highlights
Yeah.
an annualized total return
Yeah.
of 11.2%,
11.2%. That's not bad at all.
which is pretty phenomenal.
Well, that's beating the market for sure over that period.
It is.
Yeah.
So what's driving it?
What's driving it?
What's driving that?
Can they keep it up?
Yeah, can they keep it up?
Those are the two big questions.
That's always the question.
right. Exactly.
The past is great,
Yeah.
but we want to know what's going to happen in the future.
Exactly.
Yeah.
So first off,
Yeah.
a lot of their power generation
Okay.
is sold under long-term contracts.
Okay. So that's
Like predictable income, right?
It is.
That's good for a business like that.
And
Yeah.
the rates are often linked to inflation.
Ah, very good.
So
So they have some protection there.
built-in protection.
Yeah, inflation hedge. Yeah,
Right.
that's really smart.
As cost of living goes up,
Yeah.
their revenue goes up
It's going up with it.
right along with it.
So that's a really nice feature
Exactly.
to have in this type of business.
And this is expected to boost
Right.
their funds from operations.
Yeah.
Or FFO.
FFO, you can kind of think of it like cash flow
Yeah.
for,
So just for people who aren't as familiar
Exactly.
with the term.
Yeah.
It's essentially the cash that they generate
Right.
from their operations.
From their operations.
Yeah.
And it's expected to boost that per share by about 2 to 3% annually.
Okay, so just from that alone.
Yeah.
That's
Pretty solid.
Not bad.
Pretty reliable.
Yeah, it's a good base
Right.
for growth.
And then
Okay, so we got that 2 to 3%.
you also have
What else?
the older contracts coming up
Yes.
for renewal.
That's interesting.
Great,
because
Enbridge.
the market's changed. The market has changed.
Yeah.
So as those expire,
Yeah.
they anticipate being able to
Yeah.
negotiate
For their rates.
higher rates.
Yeah. Makes sense.
And that's because generally
Yeah.
market power prices have been increasing faster than inflation.
Right.
So
It's a good time to be in that business.
it is.
Yeah.
They estimate this could add another 2 to 4%
Another 2 to 4%.
to their FFO per share each year.
Okay. So on top of
On top of it.
the 2 to 3%,
Right.
we're already at like 4 to 7%.
Right.
Yeah, that's pretty good.
Pretty good.
Just from those two things.
Just from that.
Okay.
And
And I imagine they have
then they have it.
huge pipeline.
Right. They're not just sitting on their hands.
Right.
Yeah.
They gotta grow some.
They've got all these new development projects, all these new wind, solar, hydroelectric
Yeah.
energy storage facilities
Yeah. The whole thing.
coming online.
Yeah. So that's gonna add to the growth as well.
Exactly.
Yeah.
And those are expected to contribute another
Actual budge.
4 to 6%
4 to 6%. Okay.
to FFO per share growth
So we're adding that on top
per year.
of what we already had.
Right.
All right. This is looking pretty good.
So we're talking some serious internal growth here.
Yeah. They've got a lot of organic growth, it
Exactly.
seems like.
Right.
Yeah.
And then on top of that,
they've also got
they've also
big
been
this is
active in M&A,
right.
mergers and acquisition.
And they call them accretive acquisition,
Yeah.
which essentially means
That means they're buying some.
buying things that are going to
That's going to increase.
add to their earnings.
Yeah, earnings and cash flow
Per
per share.
which is what we want to see.
Yeah, we like that.
Yeah.
So all of this together,
So let's add it all up. What are we
Well,
looking at?
what kind of picture does this paint
Yeah.
for their growth?
Yeah.
Well,
picture.
they're projecting organic FFO per share growth.
Yeah, a range probably.
Between 8 and 13% annually.
8 to 13%. That's a huge range.
It is.
But I guess it depends on
A lot of factors.
how those acquisitions and those developments go. Yeah.
But even on the low end,
Yeah.
that's pretty good.
That's pretty solid.
So they're anticipating being able to grow their dividend
Okay.
at a rate of 5 to 9% per year over the long term.
Okay. So still
This is pretty good.
a nice, healthy growth rate.
It is.
Yeah.
And then when you factor in
And don't forget
their current dividend yield,
the current yield,
which is 5.3%,
5.3%. Okay.
that's pretty attractive.
So you add those two together,
Right.
and you're potentially looking at
You're
getting
talking double-digit returns?
double-digit
Potentially.
total annualized
Yeah.
returns.
If they could keep
Potentially.
hitting those numbers,
Yeah.
right,
That's great.
which is pretty
That's
good.
pretty awesome. That's what we're all looking for.
Yeah.
Yeah. So, all right, so that's Brookfield.
Let's Brookfield Renewable.
What about Enbridge?
Now let's move on to Enbridge.
Okay.
This is a Canadian company.
Okay. North of the border.
Yeah, so just a heads up there for anyone who's not familiar
Might not be as familiar with it.
with Enbridge.
Yeah. Yeah.
They are primarily in the
Yeah.
energy infrastructure space.
Okay.
So think pipelines.
Pipelines.
Mostly for oil and natural gas.
Oil and gas. Okay.
And they also have some
Yeah.
utility operations.
all right.
Now, Enbridge has a very long history
Okay.
of paying dividends.
How long?
Over 70 years,
70 years.
they've been paying a dividend.
Wow.
That's
That's a long time.
generation
That's longer than I've been alive.
of investors.
Yeah, probably longer than most of our listeners have been alive, too.
Right, exactly.
Wow. Okay.
And they've increased that payout
yeah. Okay.
for 30 consecutive years.
30 consecutive years.
That's a pretty solid streak.
That's a really long time. That's impressive.
It really is,
Especially
especially in that.
in that sector, which
Right, exactly.
can be cyclical.
It shows you how resilient their business is.
Yeah, they've been through a lot in those 70 years.
Right.
For sure.
So
yeah.
over those 30 years,
Yeah.
the compound annual growth rate of their dividend has been 9%,
9%. That's solid.
which is very impressive.
Yeah, that'll do it.
And this has led to an annualized total return
Yeah.
of over 11%
11%.
over the past 20 years.
Again, beating the market.
Yeah, it's
Pretty consistently. It's all about that consistency, right?
Consistency is key.
Yeah.
And what's interesting is,
Right.
why are they so
That's their
consistent?
secret sauce.
What is that secret sauce?
Yeah.
Right?
Tell me.
Well,
Yeah.
it's the stability of their cash flows.
Okay. It makes sense.
Pipelines and utility assets
Yeah.
generate very predictable,
Yeah. Those are pretty stable businesses.
stable cash flow.
Yeah. People need oil and gas.
Right.
They need their utilities.
And that's largely because of
Yeah.
long-term transportation contracts.
Right. Long-term contracts.
And in the case of the utilities,
Yeah.
you have government-regulated
Government regulated. Yeah.
rate structures.
So those prices aren't just fluctuating wildly.
Exactly.
Yeah.
So they have a
Wildly.
very high degree of certainty
Yeah.
with their earnings.
Yeah. They can kind of predict what's going to happen.
Right.
Which is good for a business.
And that's crucial
Yeah.
for consistently
Yeah.
funding
Yeah.
and growing that dividend.
So they know how much cash they have.
Exactly.
They know what they can pay out.
Right.
They can plan accordingly.
Right.
Yeah.
And then
Okay, so they got the stable cash flow.
Yeah.
What do they do with it?
they have a target dividend payout ratio
Yeah.
of
What is it?
between 60 and 70%.
60 to 70%. Okay.
So they want to distribute
So that's the portion of their cash flow that
Look,
they're paying out
of their cash flow
to investors.
to shareholders
Okay.
as dividends.
So most of it is going back to investors, but they're keeping a little bit.
Which allows them to
Yeah.
reward shareholders now,
Right. Yeah.
while also
You got to keep some.
keeping a
good amount.
good amount to reinvest in the business
Yeah.
for future growth.
That's smart. You need to have that balance. You
Yeah.
can't give it all away.
Exactly.
Yeah.
And they also have a very strong balance sheet.
Okay.
And they've got
That's always good.
an investment-grade credit rating,
Yeah. That gives them flexibility.
which allows them to
Yeah.
access
Oh,
capital
or cost of capital too.
at good rates
Yeah.
to
Yeah.
fund these various growth projects
Yeah.
without jeopardizing
They can borrow money
their financial stability,
without hurting their
dividend,
dividend. Yeah.
which is nice.
So that's a good sign.
Yeah.
A good, strong balance sheet is always a plus.
Always a plus.
Yeah.
And so what are these?
Speaking of growth projects,
Yeah, what are they investing in?
they have a pretty big backlog
Okay.
of commercially secured projects.
So these are projects that are
The article calls it a massive,
already signed.
multi-billion-dollar backlog.
They're going to happen.
It is massive.
Okay.
So what kinds of projects are we talking about?
Yeah, break it down for me.
They're continuing to expand their
Okay.
oil pipeline network.
So more oil pipelines?
Okay. They're building out
Makes sense.
new natural gas infrastructure.
Natural gas. Okay.
They're investing in natural gas utilities.
So they're in both oil and gas.
Yeah.
Okay.
And
That's
they're even
correct.
developing some renewable energy projects.
Oh, so they're getting into renewables too.
Yeah.
A little bit?
So they're diversifying a bit.
Right.
Interesting.
Now, okay, so
Absolutely.
these projects are under construction.
They're not just ideas.
Right.
They're actually happening.
And they're expected to come online
Okay.
through the end of the decade.
So we have some visibility
At least
into the future.
it's not just
Yeah.
a pipe dream.
It's not just a backlog. It's actually happening.
Right. They're actually being built.
Okay. So how is this going to affect their cash flow?
Right. So how does this affect their cash flow
Yeah. And ultimately the dividend.
and their dividend?
Yeah.
Well,
What do we know?
they're anticipating cash flow per share
Okay.
to grow by about 3%
3% per year.
annually
Okay.
through next year.
Okay. So next year's 2026.
2026
Yeah.
as these near-term projects come
Awesome.
online.
So that's a pretty conservative estimate.
It is
That-
pretty conservative.
Yeah.
And then they expect it to accelerate
Okay.
to about 5% annually. 5% after 2026.
After 2026.
Right.
Once these larger,
So it's going to ramp up
longer term
as these projects come online.
projects
Yeah, that makes sense.
start contributing to earnings.
Okay.
And this is expected to
So that should
lead to similar
lead to some dividend growth.
dividend growth.
Okay.
And right now,
And what's the current yield?
their current dividend yield is about 6%.
6%. That's pretty juicy,
Yeah.
especially in this environment.
Pretty nice.
Yeah.
So if you combine that,
So you're getting paid to wait.
right,
You get a
you
strong
got the potential for growth.
income stream.
Yeah. So if you
Uh-oh.
add those together,
While you're waiting for that?
you could be looking at almost 10% returns.
Right.
Potentially.
Potentially.
Yeah.
Total annual return of about 10%.
Which is not bad at all.
Yeah.
Yeah.
Pretty good.
That's pretty solid.
So to wrap up,
Yeah.
this Motley Fool article
Okay.
really highlights these two companies,
Brookfield and Enbridge.
Brookfield Renewable
Yeah.
and Enbridge,
Two very different companies.
that have both focused on
these amazing track records of growing their dividends.
Right, and that's what we want to see.
And that's what we're looking for.
Yeah.
And the data that they presented at the beginning.
Yeah, the historical data.
Shows that that's a good.
Shows that it's a good indicator of future returns.
Yeah.
Yeah.
That those companies tend to do well.
And they have the track record to back it up.
They do.
Yeah.
And they make a pretty strong case for why this trend is going to continue.
Why should we believe it's going to continue?
For both these companies.
Yeah.
Based on
their fundamentals.
Their business model.
Their growth prospects.
Their growth opportunities.
Yeah.
And their financial strength.
Yeah, they both seem pretty solid.
They do.
From what we've discussed.
It's understandable why they were highlighted.
Yeah.
As
no-brainer buys. No-brainer buys.
Yeah, they do seem pretty compelling.
And especially if you're looking for...
Especially for dividend investors.
Dividend income.
Yeah.
And...
someone looking for income.
For growth.
And growth.
Right.
Yeah, that combination's hard to find.
They both offer pretty...
They both seem
attractive combination of solid current dividend yield.
You get the income now.
And the potential for growth.
And you got the potential for growth.
Right.
Yeah.
So
thinking about all this.
Yeah, what are your takeaways?
Yeah.
If you were...
What really stood out?
Looking at these two companies.
To you.
Brookfield Renewable.
Yeah.
And Enbridge.
Which one would you pick and why?
What stands out to you?
What are those aspects of dividend investing and long-term growth that are most interesting to you? I mean, these are two very different companies. They're in very different sectors.
Right.
But they both seem to be doing well.
Yeah.
So what resonates with you?
Right.
And how might you take what we've talked about today and use it in your own research?
Yeah.
What other companies are out there that maybe have similar characteristics?
Right.
And how can you find them? And how can you...
Think about that consistency
Yeah.
of the dividend payments.
The upward trajectory of those dividends.
Right.
Yeah.
Backed by solid fundamentals.
That's what's important.
How can that contribute to...
It's got to be backed by something real.
Your long-term financial goals.
Yeah.
Right.
It can't just be a dividend for dividend's sake.
Exactly.
Yeah.
So...
something to think about.
That's something to really consider.
As you're doing your research.
When you're looking at these companies.
Yeah. And it's not just about the dividend.
And how they can...
It's about the underlying business.
Fit into your portfolio.
And about growth prospects.
Exactly.
Yeah, so that's something.
Definitely something to think about.
To keep in mind.
All right. Well, that's our deep dive.
Yeah.
For today.
It was a good one.
We'll see you next time.
Yeah, see you next time.